going to let my new subscribers in on a little secret that my older subscribers already know about. But to my older subscribers, stick around for a few minutes because I may say something that's new to you. This is a chart of the price of gold over the past 5 decades. For many gold commentators, this is about as deep as they go. They might draw some fancy lines on the chart indicating support and resistance, trend lines, maybe even wedge patterns, head and shoulders formations, or cup handles. But there's really no depth of understanding behind what they say. They're just using patterns to guess what the crowd is going to do so that they can front run the action in the hopes of using gold as a trading vehicle. For them, it makes no difference if they are dealing with gold or GameStop stock. The analysis is pretty much the same. What many don't seem to appreciate is that what we now call the dollar, which is no longer a constitutional dollar, but a bill of credit, changes over the long term. So while fluctuations in the price in the short term can be an accurate reflection of how sentiment towards gold is changing, or any other object priced in dollars for that matter, over the long term, we need to take into account that the dollar itself is being debased. To compensate for the changing value of the dollar, the U.S. Bureau of Labor Statistics has devised a measure called the CPI, or Consumer Price Index. The CPI supposedly tracks the general cost of living over time as measured by a basket of goods. We'll talk more about this measure in a moment, but let's see what gold's price looks like if we use the CPI to adjust past prices of gold and place them on a current dollar standing. And here is that chart. This plot shows the same gold price information going back to 1971, but it multiplies each data point by the current CPI and divides it by the CPI for each month going back to 1971. Now, if this chart is fundamentally useful, which it isn't, it paints a very scary picture for the owner of gold. It suggests that 2000 is about the limit of what people have been willing to pay, and gold has bounced off of that resistance level several times. Bear in mind that when I'm saying $2,000, I mean CPI adjusted dollars, with the year 2021 as the reference. But before everyone gets all panicky and sells their gold, let's discuss the CPI for a minute. After all, the CPI is not necessarily the best measure of inflation. Remember, the Austrian School of Economics defines inflation as an expansion of money and credit. They treat general price increases as the result of inflation and not as the inflation itself. So let's add a couple of Austrian school style measures of inflation to our analysis. Here's a logarithmic chart of the nominal price of gold over the past 5 decades compared to the CPI, compared to the total currency in circulation, and compared to the M2 money supply. One thing I'd like to immediately call your attention to is that up until the year 1982, the rate of change of the CPI, currency in circulation, and the M2 money supply were virtually the same. Back in the 1970s, people really cared about the money supply, and with good reason. Nowadays, most of the comments that you hear from modern economists is that the money supply doesn't matter. And that's a dangerous idea that I'm sure has a lot of political support backing it. In the 1980s, the CPI methodology started to change, and as a result, it no longer tracked the money supply figures. Some of the things that were done were probably legitimate, some were questionable, but without a doubt, we can see that the CPI starting around the year 1982 increased at a rate that was slower than the monetary aggregates. In a way, this makes sense. It's natural to assume that as productivity improvements are made, it will exert some downward pressure on prices in general. And this is why back in the days of the gold standard, when the money supply increased very slowly, we would see a general tendency to be a slow decline in prices, rather than a slow increase which has been engineered by the masters of the universe sitting in Washington, D.C. and in New York. But since I can't refashion our monetary world with the wave of a hand as I'd like to, I'll just suggest that we recognize things as they are and adjust our behavior accordingly. The most important thing that you will notice in this chart is that the price of gold does not track the CPI index. It tracks the monetary aggregates. Now, why is this? Isn't gold a commodity? No. Gold is not a mere commodity. It's a monetary asset. And so it is natural to assume that it will track the money supply. And this is what makes gold superior to bonds over the long term. Bond interest rates generally gravitate to levels that are slightly above the expected rate of increase of the CPI. And this means that bondholders over time will command a smaller share of the total dollars in existence. It's almost like the unfortunate stockholder of a company whose management dilutes the shares heavily. So for you bondholders, please know that you are being diluted. This is not the case for gold holders. While in the short term, the price of gold is a function of sentiment, in the long term, the price of gold is a reflection of how many dollars are floating around in the system. So let's do the same exercise as before, where we deflated the past gold price using the CPI. Let's also deflate it using the money supply figures that the Austrian school would suggest using as measures of inflation. Boom! There it is. The CPI adjusted gold price still paints a pretty scary picture, but the gold price charts, where we adjusted the past prices for currency in circulation and the M2 money supply, present a much more favorable picture. We can see here that in order for gold to be as extremely valued as it was in 1980, it would have to reach a price level somewhere between $8,000 and $11,000. Can it happen? Absolutely. All that's required is a crisis in confidence in the currency. To even match the price peak seen in 2011 would require a gold price that was somewhere in between $3,000 and $4,000 on a money supply adjusted basis. Now, can the price of gold fall from here? It sure can. If the price were to drop to the $1,000 to $1,500 range, it would bring us back to valuations we haven't seen since 1971 or 2001. And those were the bear market lows. Now, $2,200 per ounce is about the median price level of the past 50 years from a money supply adjusted standpoint. One thing I would like to make absolutely clear to everyone, though, is this. The longer people wait in cash for lower gold prices, the more additional money is going to be printed. I'll say that one more time. The longer people wait in cash for lower gold prices, the more additional money is going to be printed. I personally am much more comfortable being a passenger on the gold train than a passenger on the dollar train. There are some much bigger sentiment shifts in gold, but at least it's not on a treadmill to oblivion. Gold. Get you some.